Silver isn't disappearing the way people imagine shortages happening. There's no dramatic empty shelf moment. No breaking news clip of vault doors swinging open to reveal nothing inside. It's disappearing the way the most dangerous shortages always begin, quietly, invisibly, and inside systems that most people never watch. Silver is vanishing ounce by ounce into products that don't get recycled, into supply chains that don't announce stress until they're already strained, and into long-term contracts that remove metal from the open market without a headline. And that is exactly why the market isn't ready for what comes next, because most investors still think silver is a trade, while the real economy is treating it like a strategic input. Here's the core problem. Silver is one of the few materials on Earth that sits at the intersection of modern technology, national security, and monetary psychology. It's not just a shiny metal people buy when they feel nervous. It's a critical conductor used in solar panels, EVs, data centers, semiconductors, advanced electronics, medical equipment, and defense systems. And unlike many commodities, silver is consumed. Once it's used, it often becomes unrecoverable at scale. That means the world is not just using silver, it's gradually removing it from circulation. And when a material is both essential and disappearing, the repricing tends to arrive suddenly, not politely. If you stay with me until the end, you'll understand the hidden mechanism that makes this story so explosive. How paper pricing can look calm even while physical availability tightens, and why that gap can snap without warning, creating a move most people only understand after it's already happened. Let's start with what quietly disappearing really means. Silver is extracted from mines, refined, fabricated into industrial forms, and then shipped into manufacturing. In the past, large portions of silver demand came from categories that either returned silver to the market, like certain forms of scrap, or didn't grow fast enough to overwhelm supply. Today, the growth categories are exactly the ones that permanently disperse silver into the world in tiny amounts. Electronics, solar cells, sensors, connectivity hardware, medical applications. When silver is used in small quantities across billions of units, it becomes economically difficult to reclaim. Recycling exists, but it doesn't scale fast enough, and it doesn't capture most of the dispersed silver. This is the first reason the market isn't ready. People still picture supply and demand as something that adjusts smoothly. In reality, silver demand is becoming more like a one-way drain, a steady outflow into the modern infrastructure that powers daily life. The second reason is on the supply side. Silver supply doesn't behave like people expect. Even if silver prices rise, mines cannot simply double output next quarter. New mines take years to develop. Existing mines face declining ore grades. Costs rise with energy, labor, and regulatory pressure. And critically, much of the world's silver comes as a byproduct of mining other metals. That means silver production is often tied to the economics of copper, lead, zinc, and other mining decisions, not silver alone. When silver becomes scarcer, supply response is slow. That creates the kind of imbalance that can build quietly for years. So you have a world where the demand side is structurally rising and the supply side is structurally constrained. That alone should put silver on every macro investor's radar. But here is why it doesn't. The silver market is split into two realities. There is the physical market, the metal that must actually be refined, delivered, and used. And then there is the paper market, contracts, futures, ETFs, and financial products that trade in enormous volume without necessarily moving physical metal. Paper markets are not fake. They serve a purpose, but they can create an illusion of abundance because you can buy and sell huge quantities instantly. That gives the impression that silver is deep and liquid. The physical reality is different, and this is where the quiet disappearance becomes dangerous. Because physical stress often shows up first, not in the headline spot price, but in the things most people don't track. Delivery times, premiums, contract restrictions, private supply agreements, and the willingness of large institutions to part with metal. When the market is healthy, these signals are boring. When the market is stressed, these signals become the real story. Now let's talk about what is pulling silver out of circulation so quietly that most of the public doesn't notice. Solar is a major driver. Modern solar panels require silver for conductive paste. Manufacturers can thrift and improve efficiency, but demand growth is huge and global installations keep rising. Solar is not a luxury industry anymore, it is becoming core infrastructure. That means solar demand for silver is not cyclical the way some industrial demand is. It's strategic. Electric vehicles and electrification are another driver. EVs use more silver than traditional vehicles because the electronics content per vehicle is higher. Sensors, power systems, charging components, and connectivity all require conductive materials. As vehicle fleets electrify, silver demand rises with it. Again, it's structural. Data centers and advanced computing are another quiet drain. AI infrastructure is not just software, it's hardware at scale. Servers, power management systems, networking equipment, and specialized electronics all consume silver. The world's appetite for compute is accelerating. That creates another long-term pull. Then there's medical technology and defense. Silver's antimicrobial properties make it valuable in medical equipment, wound care, and sterilization applications. Defense systems rely on advanced electronics and communications. These are not industries that pause demand easily. They plan long-term and secure supply. Put all of that together, and you get a market with rising baseline demand. And when baseline demand rises, it does something subtle. It reduces the cushion. The cushion is above-ground inventory, the metal sitting in vaults, warehouses, and readily deliverable forms that can absorb disruptions. When demand rises year after year, inventories are used to fill gaps. That drawdown is not obvious to the average investor, but it is a critical signal to institutions. This is why the market may be unprepared, because most people believe prices would have already moved if there was a serious problem. That assumption is wrong. Markets can remain mispriced for long periods when the paper layer is heavy and when the public narrative is distracted. But physical reality doesn't care about narratives. Eventually, if availability tightens enough, the price must adjust, sometimes violently. Now, what does "not ready for what comes next" actually mean? It means that when the shift happens, it will surprise people who are watching the wrong indicators. They will be watching charts and headlines while the real change happens in access and availability. They will think the market is calm until suddenly premiums jump, delivery times stretch, and prices move fast. There is also another reason silver moves can be dramatic. Silver is a relatively small market compared to other major assets. It does not take the same level of capital to move silver prices that it takes to move large equity indices or major bond markets. That means when investment flows arrive, especially during moments of macro stress, silver can reprice quickly. A small market with constrained physical supply and rising demand becomes sensitive to even modest changes in sentiment. And sentiment can change faster than fundamentals. Now, here is where banks and large institutions enter the story. When silver is quietly disappearing, the most important signals come from the people closest to the supply chain. Banks and large commodity intermediaries are not emotional buyers. They don't chase headlines the way retail does. They manage risk. They plan for scenarios. They look for markets where the cost of being wrong is high. If a bank believes silver can tighten, the risk is not just price goes up. The risk is delivery obligations and short exposure in a market where physical metal becomes harder to source. Institutions hate that risk. When they sense it, they adjust quietly, they tighten terms, they hold more inventory. They become less willing to provide metal into the market. That behavior itself tightens the market further. It becomes a feedback loop. When big holders become reluctant sellers, supply becomes less available. When supply becomes less available, buyers become more urgent. When buyers become more urgent, prices become more sensitive. This is the kind of loop that creates sudden breakouts. The next question is obvious. What could trigger the moment the market finally wakes up? It could be a macro shock, something that pushes investors toward hard assets. It could be inflation pressure returning in a new wave. It could be a recession risk that forces policy shifts. It could be a geopolitical event that disrupts supply chains or increases defense demand. It could be a supply disruption at a major mining region. It could be a sharp rise in industrial demand due to energy policies. Often, it isn't one big event. It's a series of smaller stresses arriving when inventories are already thin. The key is that silver doesn't need the world to run out of silver to reprice. It only needs a shortage at the margin, deliverable, refined silver available to meet demand right now. Pricing is set at the margin. When the margin becomes tight, price becomes unstable. This is where paper versus physical becomes the central risk. In calm periods, paper prices lead and physical follows. In stressed periods, physical leads and paper chases. The market isn't ready for the moment when that relationship flips. Because when it flips, the chart moves faster than most people expect, and the narrative changes in days rather than months. So what should the viewer take away from this? Not that silver is guaranteed to spike tomorrow. Not that every bank is plotting. Not that the system is ending. The real takeaway is more valuable and more realistic. Silver is quietly disappearing into the real economy. The supply chain is not expanding fast enough to replace it. And the market's pricing mechanisms can remain calm until they suddenly can't. And if you want the most important mental model to hold on to, it's this. When a material is both essential and consumed, shortages don't announce themselves. They reveal themselves through behavior, through tighter contracts, longer lead times, rising premiums, and reluctant sellers. Those are the signs that the system is losing flexibility. If you're still here at the end, here is the final point that most Americans miss. And it's the reason this story matters beyond investing. Silver is not just a metal trade. It is a hidden input to the technologies society is building its future on. A silver squeeze does not just move prices. It pressures the cost of solar deployment, electrification, electronics manufacturing, and advanced infrastructure. It becomes part of the inflation picture. It becomes part of the supply chain picture. It becomes part of the national security picture. That means the impact of silver tightness shows up in the real economy, whether the public notices or not. Silver is quietly disappearing, and the market isn't ready for what comes next because most people still believe important shortages start with loud headlines. In reality, they start with silence, and they end with repricing.